All right, good morning, everybody. It's Michael again. We're back at it. Happy New Year to everybody. I hope 2023 brings everything you hope for and more to you and yours. We had a good time over the Christmas and New Year holidays, and it's time to get back to work now. The markets are opening again tomorrow. They're closed today, mainly in the U.S. and I guess around the world. Everybody is on holiday today still, in most places, I think. But we're back at it from tomorrow. So today I thought I would continue on with laying the foundations for you. And thank you to all of you who've responded to the videos so far. The response has been, humbling. I appreciate all the kind words and the emails, and also the comments on the YouTube videos. So please continue to like and to subscribe and to share the videos when you get them, if you appreciate them. I hope it's useful for you. So today, what I thought I would do was go into how we filter the zones that we choose to trade. In the supply and demand community, they're called different names. I call them filters. Other people call them odds enhancers. They're basically measurements that we take to assess the quality of the zones, because as you probably realize, there are supply and demand zones everywhere you look on the price charts. And it's often a dilemma, particularly when you're starting out new, which zones to take. So I thought I'd try and give you a bit of a foundational explanation as to what you're looking for. There are several odds enhancers, but we're going to take them one by one so that the videos are not too long, but also that we do them justice when we spend a decent amount of time on each one. So the first one we're going to talk about today is strength. The strength of the move away from the level. You'll recall that in our previous videos, I mentioned often about what should attract your eyes to a level, what normally would attract your eyes to a level. And we said that it would be how prices left, the big candles, the big moves. Now, there are several of those kinds of moves on the charts, as you probably have realized doing your own work on your charts. This process is to help you to choose the, most appropriate, ideal type of levels. And we'll start, as I said, with the strength. So I've just made a few notes for you so that when you're watching the video, you'll be able to understand and follow along. Now, when we're talking about the strength of the move away from the level, there are a few things that we're looking at. We're looking at, firstly, how large the imbalance was when prices left that level. That's that big move that I was talking about. And I'll show you on the chart, as you know. I do a lot of my teaching and my work on the charts, but I thought I'd make these notes first. So when you're starting from current price, and you're looking down and left for demand or up and left for supply, and your eyes are attracted by those large candles, those large moves, that's what you're looking for. So that they pass what I call the eye test. Now, what you want to do is be a bit more, I suppose, deliberate and systematic about it. How big is it? So it looks big. It looks big to my eyes, but can I actually measure it? And that's where supply and demand traders look at the size of the body of the candle relative to the range. You can actually code for that on TradingView. I'm sure you can do that on Thinkorswim or TradeStation as well. So you're looking at the size of the body of the candle relative to the high to low range. Okay. You want to set a threshold. If the ratio of the size of the body to the high to low range is greater than X percent, then I will classify this as a large candle. That's one way of doing it. It's not the only way, but I'm giving you the most common way, where supply and demand traders refer to, 50% candles or non 50% candles. 50% candles are those candles that don't meet that 50% threshold of the range, the open to close range relative to the high to low range. So whilst we're talking, and as I said, I'll show you on the charts, but let me just give you a visual of what we mean. So say we have that as the high, that as the low. And the high measures 100 and the low measures 0. It's 0%. That's the starting point. Right, let's even put the percent next to it just to. Okay. Let's put that as well. Okay, so 100%. Oops. I will leave it then. It doesn't want to allow me. But anyway, you get what I mean. 100% high, 100% low. Then you have the body between the high and the low. That's the body of your candle. Okay? That means you have a wick up there and a wick down here. I'm not going to draw them in because I don't want it to clutter the chart, but what you're assessing, the commonest way supply and demand traders assess how large the imbalance on departure from the zone is by measuring the size of the body of the candle that left the zone, the size of the first candle. It's usually the very first candle that leaves the zone. So you'll recall in the previous videos, we talked about how you would isolate your levels. You have your base. You're looking in this case for that first candle that leaves that base. And if you haven't watched the previous videos, please go back and watch it so that this makes sense. And I'll try and put a link at the end of this video as well for you for the first 3 installments. So we're assessing the size of this body relative to the range, the high to low range. Where supply and demand traders say it's a 50% candle, what they are talking about is that the range of this body relative to the high to low range is 50% or less, meaning the body is small relative to the high to low range. You don't want those kind of imbalances. It might close up. This would be the open. This could be the open. Yeah. And that will be the close. It's an up candle, but is it the kind of imbalance that we want? No, obviously not, because the size of the body, which is used as the proxy for measurement of imbalance, most commonly, it's not the only way, but most commonly, the size is too small relative to the high to low range. Okay, now you can apply other filters to that. You can decide you want to look at the size of the body relative to other candles around it for the last X periods, if you like. You can decide you want to look at where this close is in the range between the high and the low. That's another filter you can use. So as always, on this channel, as I talk to you, there are a myriad of ways that you can, slice something up within the methodology we use. And I think within trading in general, there is never one best way. There's no such thing. Don't let anybody box you into believing that this is the best way or it's the only way. That's never the case. There's no such thing as best or perfect or only. No, that's clickbait. There are different ways you can do it. You can do a conglomeration of everything. You can put them together. You can increase the strength or the power of your filter, or you can leave it simple and just take only one measurement, which is what is the size of the body relative to the high to low range. End of. If it's greater than a certain threshold percentage, you decide. You can decide, I want candles, I will classify a candle as large if the body relative to the high to low range is 60% or 70% or 51% or heck 63%. You decide. So you look at your past trades, you look at when you're doing your historical analysis, when you're looking at levels, when you're back testing, what kinds of levels jive with you the most. What levels are you seeing in your work that are working more frequently than others, for example? That's what you want to do. There's a lot of information the market is throwing at us every day. We want to apply these filters to be able to see through all that information, to be able to get to what we're looking for, what rhymes with us. Okay? So that's the first test. Okay? It's just the first test, and that took us about 11 minutes. But it's important. I'm as I said to you in the previous videos, I'm being deliberately slow in this so that you get the foundations right. Once the foundations are right, you can build whatever you want on top of it, whether you're using other tools, whether it's Fibonacci or Wyckoff or stochastic, whatever you're doing, you can add, but your foundations must first be solid, as in every house. Okay? So how large was the imbalance on departure from the zone? The very first candle, to summarize, it's the very first candle leaving the zone that you want to measure. Now, one caveat to that, and I will show you an example of this in Tesla. Let's go back to Tesla. Is a gap. So as you guys know, if you're a practitioner of the supply and demand methodology, the biggest representation of a price imbalance is a gap. Yeah? Now notice this level in Tesla that has been the supply zone that's resulted in this big move where institutions sold. This is an example. It's something we've talked about on the roundtable a few times, but I thought I'd show it here. Notice the candle, what we were just talking about. The candle that left the zone. This candle. Where is my arrow? This candle right here. So depending on the threshold you set, that candle is about 40.3%. The open to close range, which is the body, relative to the high to low range of that candle is about 40.3%. If you set a threshold of 50 or 44 and higher for you to identify your level, and you are looking, in fact, I hope this doesn't mess up the video. Let's do a quick replay. So this is where we were. So you're looking at this market like this. You see that we're making lower highs, lower lows. We're taking out pivots. So you assess that we're in a downtrend. You've come into some demand here, but you've identified this, and you now want to evaluate the strength of the move away. First thing you notice is there's a gap. The biggest representation of an imbalance is a gap. You've learned that. You've now identified it. Okay. Now you also have a filter that the first candle that leaves the zone, you want it to be a large candle. So you are looking at this candle, and your large, by large, your filter is, I want the body of the candle to be at least 50%. And then you measure this, and it's 40. And in my case, I've coded everything I'm looking for into the colors and into the shapes of what you're looking at. What rhymes with me. It may not be the same for you, but this is what I look at. So you're seeing that candle is not, it's not big enough. Are you going to score the zone any differently? Is it going to make a difference to your decision matrix? Which I'm hoping you're all building, by the way, with these videos. That's the whole idea at the end of it all, that you'll have enough information to have your own decision matrix. Are you going to evaluate this supply zone as different to, say, this supply zone, for example? You probably will. Because, for example, that one has clearly a bigger body relative to the range. Yeah, almost 58% compared to this one, which is nowhere near big enough. Yeah. So that's the strength that you're assessing. This one, for me, met the criteria I look for because of that definition, that the biggest representation of an imbalance on a price chart is a gap. So I already have my strength of move away measurement. That would score highest. Everything else that happened after the gap, for me, not really mattering as much as the gap. Okay? So that's what we were looking for. Okay? That's the strength. Let's go back to the lesson. So that, I just thought I'd show you that quick example. Let's see how far we get now. Okay, I'm gonna delete all of this, make it less cluttered. All right, so how large was the imbalance on departure from the zone? So I've already given you two examples. Was it a gap, the biggest representation of an imbalance? Was it a big candle? What do you define as big? Greater than 50, greater than 60, greater than 70, greater than whatever number? You decide. Okay? The next point is, how far did prices move away from the level? That's another measurement, which is basically the distance that prices moved away from the level. So let's go back to the Tesla example. How far did prices move away when they left the level? Within the supply and demand methodology, the minimum distance, we're taught is 2 to 1. That's the starting block, meaning relative to the size of the zone, from your distal line to your proximal line, how far did prices depart? Now you'll notice I have some numbers on my screen. Let me take out the arrows now. And we'll zoom in a little bit in here. Yeah. So you'll notice 2, 3, 4. You might not be able to see 1 and 0 in here. But again, this is just a modified fib tool to use as a measurement. And I'll show you. So I'm looking for that. So 0 and 1 would be where the zone is, from the proximal to the distal. And then everything else measures. So 1 is where the proximal line will be. In fact, let me put 0. Let's put 0 in so you can see 0 as well. 0. So you might not be able to see it there, but it's right there in the red. Let's see if we can zoom in, because there's no, yeah. So that's it right there. That's 0. That's 1. Okay. They measure the distance from your proximal line to your distal line. Then everything else, that's a 1-to-1. Where it says 2, that's a 1-to-1, meaning the distance from 1 to 2 is equal to the distance from 0 to 1. Okay, so that's 1-to-1, that's 2-to-1, that's 3-to-1. where it says 4, and it goes on and on and on, 5, 6, 7, like that. Okay, you can set however many you want. No secrets, no drama. Count it out. It's just a measuring tool. Okay, so this move away, when prices left the level, how far did prices move away from the level before meeting demand, before experiencing a significant rally? Because we're looking at supply now, you want to know how far prices dropped. If you were looking at demand, for example, you would want to know how far did prices, let's reverse that. You would want to know how far did prices go before meeting supply. So literally that's the first opposing candle, the first red candle there. So you measure it to the high because it's a demand zone, and you're looking at this thing is more than a 10 to 1 if you drew your demand zone like that. If you now notice what we talked about last week, depending on where you put your proximal line, remember the distal line is always at the lowest low in the base in a demand zone. Your proximal line is where you have flexibility. So if you put your proximal line at that high, it suddenly makes it look like it's just over a 10 to 1. If I put it to the body, it looks like that's like a 12 to 1. So that can make a difference depending on the size of the zone, how you draw your zone. Remember what I said last time, just be consistent with how you draw the zones. Don't fudge. Don't try to make it fit because you've not had a trade for a week or 2 weeks, or you're in a bit of a losing streak and you're looking to get back some green in your portfolio. You start to, fudge your rules. Try not to do that. Recognize when your emotions are leading you to try and do that, and take appropriate steps to avoid making that error. You want to be consistent with what you are doing every single time you go into the charts. Okay, so to this example for the supply zone, it moved away at least a 2 to 1. So it met the minimum criteria that we would look for. Now let's take a step back and do a little bit of a deeper dive into why 2 to 1. What's special about 2 to 1? Again, like I always say, there's no magic, there's no secrets, there's nothing new under the sun. Why 2 to 1? Well, why don't you look for 3 to 1? There's absolutely nothing that says you can't. Absolutely nothing. It's just a threshold. If you decide, I only want to take zones that have moved a distance of 3 times the size of the zone, then do that and remain consistent with it. What you will find is that you will get less trades. Again, remember those trade-offs I tell you guys. There's always advantages and disadvantages to everything in trading and in life. You'll get less trades, but you probably get better quality trades. So you might have to sit on your hands for longer periods if you're of that type of personality, and you're able to be patient and only take those zones that are measuring 3 to 1, then that's what you do. If you add an additional filter, for example, and say, ideally I want a 3 to 1, yes, that's what I want, and those are the kind of zones that I would consider putting my max position size on. But if I have zones that are 2 to 1, I won't not take the trade. I'll still take the trade, but I won't put my max position. You might have said, maybe I'll put 25% of my usual position, or maybe I'll put 50%, or 75% of my usual position. Again, you decide. Okay, these are all just thresholds, and I'm not. This is what I'm doing deliberately, not to box you in and say, it has to be this. What you don't want to do, however, is to take levels that are 1 to 1, for example, or 1.5 to 1. Why? Why don't you want to do that? Well, let's think about, what does that move away represent? What does it stand for, that move away? Well, here it is. When prices leave a level, every single price point until it turns around has been traded through. I think we will all agree on that. For prices to get to this low, for prices to reach this low, they have traded through every single price point. And there are subsectors of price points all within this level. They've traded through every single price point, meaning any demand that was over on this side, I'm using the big arrow deliberately to get your attention. Every demand that was on this side up to this level, right up to this price, has been traded through. Every single demand, every single buyer who wanted to buy as prices left that level has had their order filled. What that does is show you a representation of your initial profit margin. And that's something that is critically important. There's a saying we have on the round table: no profit margin, no trade. Okay, so that move away, that initial move away, how far prices moved away from the level before rallying back, is very, very important as a measure. Okay, you don't want it to be just 1.5 to 1 or 1 to 1, because if it's 1 to 1, for example, that means that prices only moved an equal distance to the size of your level. It's not big enough. That's a 1 to 1 profit, which is not big enough for the way that I trade. Not big enough for the way that most supply and demand traders trade. Okay, because you have to understand the methodology, depending on your level of proficiency, can be quite of course, on the way you use it, can be a low hit rate methodology. It can be, depending on how you use it, which is why some supply and demand traders will say, for example, that they will only take trades in the direction of a trend to try to increase that hit rate, rather than just buying as things are going down, ending up being what would be termed a counter trend trader, just trading for bounces, which can be successful, but probably not when you're starting out. Okay, so second point done. The distance moved away. I've given you reasons why. I've given you what the filters you want to look at should be. I've given you options as to what those filters, the thresholds you apply to those filters can be. So just to recap to where we are, how large the imbalance on departure from the zone was. Most common way to measure that is the size of the body. It's not the only way, but it's the main way. Within that is the fact that the biggest representation of an imbalance is a gap. Okay, so if you have a gap, it trumps everything, as it's the biggest imbalance. So it was a large move away just from the sheer fact that it was a gap. Point number 2 is what we just discussed. How far did prices move away from the level? Most supply and demand traders want a minimum move of 2 to 1. Some traders apply even a higher level filter to that and say they will only take trades of a 3 to 1 or a 4 to 1, and use that to determine their risk size, for example, or one of the inputs into how they determine their risk size. So if it's a 4 to 1 move away, I'm allowed to put my max risk, for example, if these other things X, Y, Z are also present. Okay, it's not the only input, but it could be one of the inputs. And this is how you're building your trading business, your parameters. Yeah. Let's go to the last one. Did the price movement achieve price discovery? Meaning, if you're a demand zone, for example, Did prices make it to new highs? If you're a supply zone, did prices make it to new lows? Going back to our Tesla example, and I'll show you a few other examples on the currencies and things in a second, in the last few minutes. So, did prices make it to a new low? Is basically what we're asking of our supply zones. For our supply zones to be decent quality, we're looking for supply zones that are making fresh lows. That's price discovery. So you can see here, that's the low immediately to the left of this supply zone, this drop base drop. That's the low. Did prices make a new low? Obviously they did. So that criteria is fulfilled. Again, you're fine with that zone because it moved away with a gap. It traveled a minimum of 2 to 1. The third filter, it made a new price low. Now, one of the other ways that we ask the same question or try to achieve the same question is, did prices remove an opposing level? Did prices remove an opposing level? Okay, and you'll see that. In fact, let me try and change this one to a daily and see if we have what we want here. Right. So look at this daily level. This is, again, I'm going to play the replay. Where is the replay? In fact, let's do that again. Let's do that again. Okay, so you're assessing this level. It's a drop, base, drop. Depending on where you draw your zone, does it make a 2 to 1? No matter whether you draw it body to body at the proximal line to the wick at the distal line, or you draw it wick to wick, it measures the same, about the same distance as the size of the zone. So it doesn't meet that criteria of the distance moved away yet. Okay, it doesn't. It might move another candle and then achieve it, but you don't know. Right now you're looking at the zone. There's obviously another filter here which we won't get into today about whether the market accepted the imbalance and stayed away for a minimum of one period before returning. But for now, distance moved away 1 to 1. Remember what we just said. You really don't want to be taking those because that's a measure of your profit margin. Filter 2. So you could stop there. You could just decide, you know what, it doesn't even meet my minimum, move away. I'm not even going to bother to evaluate it anymore and move on to the next chart or to the next zone. That's absolutely fine. But for our learning purposes here, I want to show you it did remove an opposing demand zone, didn't it? That's our demand zone. It traded below the low of the demand. So to the point where we're asking, did prices remove an opposing supply zone if it's a level of demand, or an opposing demand zone if it's a level of supply? In this case, as we just said, it's a level of supply. So did it remove an opposing demand zone? Yes, it did. So you would score it for that fact. Yeah, you would score it for that fact that it did achieve removing the opposing demand zone. Okay? So to summarize the lessons so far, before we look at one or two more examples, and I'll talk to you about how you could join the roundtable in 2023 if you wanted to be a part of our group. How large was the imbalance on departure from the zone? How far did prices move away from the level when prices left the level? Did price movement achieve price discovery? Meaning, did it make a new high if it's a demand zone, or did it make a new low if it's a supply zone? Or another way of trying to evaluate the same thing is asking the question, did prices remove an opposing zone to the left of it? Yeah. Okay. So let's take a look at a few. Let's take a look at CAD yen. And let's look at this one. Okay. So here is the CAD yen. Here is a supply zone. Let's make that magnet on. There's a supply zone right there. Rally, base, drop. How did prices leave the zone? In a decently strong fashion. Yeah, the body is strong. It's closing nicely in the range, blah, blah, blah. Whatever the filters you are applying, it's decent enough. Yeah. It's not the greatest, but it's decent enough. So you might want to ascribe different scores. So if it's your A+ departure from the level, you might want to give it a score of, 5 out of 5 or 2 out of 2 or 10 out of 10, whatever you decide. Okay. You might want to do that because then that creates tiers for you. Again, which will also feed into your risk allocation. If you're getting levels that are scoring 10 out of 10, 10 out of 10, 10 out of 10 on different measures, maybe you want to consider, putting size on when you take those levels. But if you're having zones that are scoring 7 out of 10 on strength of move away and, 6 out of 10 on this, but the total score, out of, say, 60 is still, 45 rather than 55. Maybe you want to use not your max risk. Maybe you want to use 25% or even not take that trade at all. You set your filter and you keep your records and you review your records. And if you find your filters are too strict, meaning you're not getting enough trades and missing opportunities, you might want to lax that. But that will be driven by feedback from the markets, from your activities in the markets, not just your, what you think. You have what you think to start with. You apply your thoughts to the market through your filters. The market gives you feedback and then you adjust. That's the whole game. Okay. So move away distance. As you can see, we're looking at 6-1 at least here, which is obviously great. Moved away decent. Distance moved away 6-1. Did it remove opposing zones or create price discovery? So if we were looking to say, well, we want price discovery where the move away from this supply zone makes a new pivot low. Well, there is an argument to say those are the pivot lows that it should then hit. Obviously, it doesn't get there. So if that was the filter, the only filter for that question 3, did prices achieve price discovery? Then you would score that. You would score it 0 for that point because it didn't go below these pivot lows. Okay. If you applied an alternative filter, it's one or the other. Did it make a new price discovery and go below a pivot low? Yes or no? Okay. If it didn't, did it take out an opposing demand zone below it and to the left of it? Yes, it did, because you can see here that's a demand zone right there. A rally, a base, and the big rally out. When prices came back, they took out quite a lot of levels. Something I will point out here is, though, really, if you're talking about who took out what level, this zone right here was what ultimately took out this level. But you see, it didn't, the taking it out, it did it in a messy way. And this is a really good example. I'm glad I didn't realize this when I picked this example, but it's a really good one to show you where there are really no absolutes in the market. So as of right here, where's that replay? So as of right here, where we are now, this level of supply is sitting right there. I think most people would say, yeah, that's a level of supply. Let's measure it. How far distance wise did it go? Let's reverse that. This is really cool. I didn't realize this example was even there. So, decent move away, big red dominant candles. Did it make a minimum move of 2 to 1? Nah, I got to 1, maybe 1.5 to 1. Okay, so I score it down for that. The move away is good, but it hasn't moved away far enough distance for profit margins. So for me, my Uber filter, my big filter, my ultimate filter is, do I have a profit margin? As I said, no profit margin, no trade. So the way that I trade, I would pass on that zone. I wouldn't take that supply zone. Okay, just because that's me. Might not be you. It might be different for you, and there's nothing wrong with that. Okay, that's just the way that I trade. So going forward again, then what happened was prices went up into that level, shorts came in, and that's when they took out this zone. At least that's what we assume, because prices could have come down here, taken it out, went back up into the supply, and then continued down. It could have happened in so many different ways, but we'll assume that that's how it happened. So it wasn't exactly an ideal zone for the way that I would trade it. But the reason this supply zone would be counted as one that that contributed to the taking out of this zone is because it's the one at the extreme. Okay? Just so you are aware, it is the one at the extreme. Okay? All right, so that's on the Canadian Japanese, just looking at the strength of the move. Let's go to the Hong Kong stock market. Where are we? Random chart. Yeah, let's look at the 30-minute chart here. Where have I got this? Okay. So the 13th of December is what we're looking for. There we are. The 13th of December. So we're looking at this drop, base, drop. This one. That's the level we're evaluating as a level of supply. Yeah. I just picked random charts, random zones to give you a different flavor of different types of things that the market can present you with. So again, move away, decent, not the greatest, but okay. And they had some follow through. How far did prices move away? So I wouldn't score this, for example, just to be more specific, how prices left the zone visually, and then putting a number to it, that would get, a lower score than that one. Okay. Rally, base, drop, drop, base, drop. That drop is better than that one. Okay. So that would score lower. It would be a good score, but lower than what I would give that one, for example. Distance, price moved away from the level before coming back to it. You see that's a 1-to-1, that's a 2-to-1. Looks like it just about made a 3-to-1. Yeah. And then it came back into the level. Did it take out an opposing zone or make new price discovery? Well, if we're looking at it taking out a pivot low, that's the pivot low. It didn't. If we're looking at it even taking out any sort of demand looking type of zone, if you wanted to say that's a rally, a base, and the rally out, well, it didn't either. I like these examples I picked. They're not perfect. Excellent. So it didn't take that one out either. So you would score it down for that point. Did it leave the zone in a strong fashion? The imbalance, yes. Was it the greatest? No. But was it strong enough? Would it meet at least a minimum threshold that you set? Yes. Okay, so you score it for that. Does it move away a distance far enough, at least 2 times the size of the zone? Yes, it meant 3-1 in this case. Then the third point, when you're looking at strength, did it remove an opposing demand zone or make new lows? Making new lows because it's a supply zone. The answer is no. You would score it down for that. So looking at the fact that it was a decent move away, it moved away far enough, but it didn't make new price discovery or take out an opposing zone. I can tell you now, the way my decision matrix works, if I was taking this trade, it would be nowhere near my max position size. Because that is one of the filters. The score is one of the filters that I use when gauging my A+ trades versus my B or C trades. Okay, so I wouldn't be putting my full position size. Would I still take that? Probably. But again, I don't know that until I do other evaluations of where this zone is located, for example, of what the context is of this zone. Those are all filters that we will get to in the coming weeks. Don't worry. Remember, no secrets. Okay, so that's it there. Yeah, and by the way, no secrets means that there's nothing new under the sun. That's just the way I view things. When it comes to, for example, the filters that I apply, the reason I'm not telling you this is specifically what I do is because I don't want to box you in. Because what I do, because I'm not perfect. I'm by no means perfect. What I do is what suits me. What I'm trying to do is to give you the foundations to go out and find out what suits you if you want to use this methodology. You may decide it's supply and demand is not for you and you want to move on. You may decide, hey, this is really for me. I love it. And I want to be the best I can be at it. All right. So that's where these videos, as we're building, video by video, will hopefully help. It's my hope anyway. Okay. So that zone looks like it worked. And then you're thinking, oh man, I didn't take the zone. And now look at what it's done. And imagine this has happened in the context of you not having had a winning trade for, a week or two. And then you scored this zone and for whatever reason, either you didn't take it or you took it with not so max size. And then the thing goes and does, what's the measure here? The thing goes and does that. And you're thinking, I hate that Michael guy. No, you're very outcome focused. I'm hoping to communicate to you that it is probably more useful to you for you to be process focused. Yeah. That's one of the goals, that the outcomes we do not control. Actually, the only way that our trades work out is when other people who we will never know, probably never meet, what they think. If they agree with us and sell after we sell, then our trade works. They might be in Timbuktu, they might be in Malaysia, they might be in China, they might be in Russia, they might be in, the United States. We don't know. But for our shorts to work, they have to agree with us that, hey, prices are high enough here. We're also going to go short. And that's how our trade works. But we don't know that. The outcome is something we cannot determine. We have no influence over directly. We do have influence directly over our processes, how we identify our zones, how we assess and filter those zones, the levels of risk we take at those zones, the position size we take in the markets. Those things we have control over. And I think that's one of the things that most people would do well to focus on. Okay. All right. I think I'm going to stop it there. Just to take a minute of your time to say that, again, as usual, if you wanted to communicate with me or ask a question, or wanted to know about how you could get either the one-to-one mentoring or the videos or joining the roundtable, as you can see on the screen, the email is storehouseanalytics@gmail.com. Okay. I'm actually toying with the idea of slashing the price of the video course by 50%. I mean, it's really useful information, and the feedback I've had over the years from it has been immense. And as I said, I'm at the stage where it's not, we don't need to charge so much for it. So that probably will go down by about 50% starting this month. So if you're interested in a set of 7 videos of me teaching one of my students who has now gone on to be a proficient trader in the US, then by all means contact me. It's a set of 7 videos, as I said. If you wanted more hand holding and wanted to come on one-to-ones with me, then that's also fine. Someone contacted me and asked me, when I sent them information about what the different options were, and said, well, what's the course content? What do I get? And I thought that was really a good question. So I thought I'd mention it here, that look, there's a lot of information already out there on supply and demand, on the internet, on YouTube. As I said before, there are lots of channels, whether that's from the Online Trading Academy crew or whether that's from past students. There's lots of good information. In my several years, over a decade now of applying this, what I found though is that that's never been enough. It's not just having the information, it's putting it all together and then applying it to the markets. That all the people that I have trained, like Austin and several of the other guys on the roundtable, what they've learned coming onto the roundtable or into one-to-one sessions is how you put all of the information to use. There's new information that you'll get. There's clarification of some of the inaccuracies in the videos that you see online that you'll get. But there's a lot of new information and the chance to be able to interact and ask those questions that you've always had. That's where the one-to-one comes in. You also have the accountability side of it, because I have expectations of the people that I take on. You have homework. You have to submit. There are people who I have stopped training or who I have decided not to take on because I didn't get the sense that they were ready. So because I'm just one person, I can't and I don't take everyone on. That's why I ask a few questions. I talk to people before I take them on. But it's really that hand holding, that guidance that you get. Okay, there are 1 or 2 bells and whistles that I give you when you come on the mentoring. And I have had students from every single continent. I think bar South America. I've had Central America, but I don't think I've had anyone from South America yet. That will be cool. But yeah, so the one-to-one sessions happen on the weekends, a very early morning my time. So it's Saturday mornings usually for me, where I do the mentoring sessions one-to-one, send you a link, we join the room together and we go through the process. So that's the second way. And then there's the round table, which is a weekly meeting every Sunday that members meet up in a room and we go through the charts. This is a group of friends now who look at the markets in similar but not exactly the same ways, because groupthink is the most dangerous thing in the world, I think. So there's lots of exchanging of ideas, there's identification of levels, assessing of quality, looking at macro, looking at the sub-macro picture of the markets and identifying tradable markets, levels, asking people what they think, getting a second opinion. That's what the round table really is, and that's why we named it the round table. Because even though I'm the convener, these are people who have now been trained in the methodology and are proficient, and they come with their own ideas, and some of them are doing really well, as and we're helping the others who are just coming through as well into that group. So that's a monthly subscription, the round table. Again, that's something I'm thinking of reducing the price, but at the moment I think it's about £80 a month. That probably will go down to maybe 50. I don't think we need it to be that high, but I haven't decided that. So we'll see how we get on. So thank you all for your time. It's again another long video, but you know why. I'm more interested in the quality of the videos than anything else. So if you have to pause it, please do that. I wish you all well, and I'll see you in the next video. Take care, everybody. Bye for now.